There is an invisible current in the world of money, a force so powerful it can make brilliant people do foolish things, and entire industries march in lockstep toward a cliff. It's a pressure that whispers in the boardroom, shouts from the headlines, and infects the logic of even the most seasoned executives. It's the deep, primal urge to copy, to conform, to find safety in the crowd. Warren Buffett has a name for this force. He calls it the institutional imperative, and understanding it, truly understanding it down to its psychological roots, is the single most important defense you can build against the bad advice, the market manias, and the corporate fads that destroy wealth. We are taught to follow the smart money, to see where the big institutions are placing their bets. But Buffett's entire career, his entire fortune, is built on a single earth-shattering insight. The smart money is often just a herd. A well-dressed, confident, articulate herd, but a herd nonetheless. And herds are prone to stampede. This isn't just a lesson for investors. It's a critical insight for any leader, any entrepreneur, any professional who has to make high-stakes decisions in a competitive environment. The institutional imperative explains why companies that preach innovation all end up with the same bland logo. It explains why banks that employ armies of PhDs in risk management all end up holding the same toxic asset. It's the invisible gravity that pulls all organizational behavior toward a mediocre and often dangerous mean. To resist it requires more than intelligence. It requires a specific kind of courage. The courage to look foolish in the short term. The courage to be inactive when everyone else is frantic. The courage to build your decisions on a foundation of independent thinking, rather than the shifting sands of popular opinion. This is the story of that courage. It is a deconstruction of the single most powerful psychological weapon in Warren Buffett's arsenal. We will break down this institutional imperative into its core components. We will not just define it, we will dissect it. We will explore the real-life stories where it led to ruin and where defying it led to riches. We will dive into the behavioral finance that explains why our brains are so susceptible to its pull. And most importantly, we will forge this knowledge into a set of practical, applicable mental models, a blueprint you can use to protect your capital, your career, and your legacy from the folly of the crowd. This is your defense against the siren song of conformity. This is the final promise of independent thought. Our journey begins by defining the enemy. Before you can fight it, you must see it clearly. The institutional imperative is not some vague business school theory. It is a concrete and observable force. It is the tendency of organizations to mindlessly imitate the behavior of their peers, driven not by logic or sound business strategy but by a deep-seated fear of being different. To truly grasp its insidious power, we must travel back to the 1960s, a time when Warren Buffett was a young, relatively unknown money manager in Omaha, Nebraska, running a small private investment partnership. The titans of the financial world at that time were not in Omaha, they were in New York, managing the massive mutual funds that were exploding in popularity. These were the so-called smart money, the experts to whom millions of Americans entrusted their savings for retirement and financial freedom. But as Buffett looked at their behavior, he saw something deeply troubling. He saw the institutional imperative in its purest form. He noticed that the vast majority of these funds, despite their brilliant managers and their high fees, produced returns that were remarkably average, barely tracking the overall market index. Why? The imperative provided the answer. A fund manager's primary goal, in practice, was not to maximize returns for their clients, it was to keep their job. And how do you keep your job in a large financial institution? You avoid standing out in a negative way. If you buy a portfolio of obscure, undervalued stocks, and you're wrong, you're fired for being a reckless maverick. But if you buy the same 50 popular blue-chip stocks that all of your competitors own, and the whole market goes down, you're safe. You can't be blamed. You simply fell victim to a market downturn, just like everyone else. Your poor performance was conventional. You failed, but you failed respectably. This created a perverse incentive. The entire industry was engaged in a practice Buffett derisively called closet indexing. They would buy a collection of stocks that closely mirrored the S&P 500, ensuring their fund would never deviate too far from the benchmark. They hugged the average. Yet for this service of simply mimicking the market, they charged exorbitant management fees, typically 1% or more of assets, plus trading costs. In his partnership letters from that era, Buffett was scathing in his critique. He saw this as a betrayal of trust. The managers were prioritizing their own career risk management over their fiduciary duty. The imperative to conform, to look like every other fund, was stronger than the drive to deliver genuine value. He wrote about the conventional viewpoint that it is better to be wrong with the crowd than to be right alone. This, he argued, was the philosophical bedrock of institutional mediocrity. The entire structure of the industry, the way managers were compensated, the way performance was reviewed quarterly, the way the financial press covered the horse race, all reinforced this behavior. A manager who took a bold, contrarian position and was right might be a hero for a year, but one who took a bold position and was wrong was unemployed. The math for self-preservation was simple: imitate, diversify into blandness, and collect your fee. Buffett saw this not as an anomaly, but as the default state of large organizations. The herd provides warmth and safety. To venture out alone is to expose yourself to the elements. This early observation of the mutual fund industry became the foundational anecdote in his understanding of the institutional imperative. He saw that the experts were not playing to win, they were playing not to lose. And in the world of investing and business, that is a losing game. It's a guarantee of mediocrity and a fertile ground for the bubbles and manias that would follow. This powerful tendency to imitate, to follow the herd even when it makes no sense, isn't just a quirk of corporate culture. It's a deep-seated feature of human psychology, hardwired into our brains over millions of years of evolution. To understand the institutional imperative on a cerebral level, we must look at two powerful cognitive biases: social proof and career risk aversion. Let's start with social proof. This is the psychological phenomenon where people assume the actions of others reflect correct behavior for a given situation. If you're in a foreign city and see a crowd running in one direction, your first instinct isn't to conduct a rational analysis of the situation. It's to start running with them. That instinct kept our ancestors alive. The person who waited to see if the rustling in the bushes was a saber-toothed tiger or just the wind didn't pass on their genes. The one who ran with the tribe did. The classic demonstration of this is the Solomon Asch conformity experiments from the 1950s. In these studies, a subject was placed in a room with a group of actors and asked to perform a simple visual perception test, matching the length of a line to one of 3 other lines. The actors would all intentionally give the same obviously wrong answer. Over a third of the time, the subject, despite knowing the correct answer, would conform to the group's incorrect choice, overriding the evidence of their own eyes to avoid the discomfort of standing alone. Now translate this to a corporate boardroom. The line test isn't a simple visual task, it's a complex, multi-billion-dollar acquisition proposal. Several senior executives endorsed the deal, citing that their main competitor just made a similar acquisition. The data might be ambiguous, the price might seem high, but the social proof is overwhelming. Everyone else is doing it. To be the lone voice of dissent is to be the subject in the Asch experiment who says, "No, you're all wrong." It's deeply uncomfortable, and our brains are wired to avoid that feeling. This is amplified by another psychological force: career risk aversion, which is a modern corporate manifestation of loss aversion. Loss aversion, a cornerstone of behavioral finance, tells us that the psychological pain of losing is about twice as powerful as the pleasure of gaining. Losing $1 hurts more than finding $1 feels good. In a corporate career, this is magnified. The potential gain of a successful, unconventional decision, a promotion, a bigger bonus, is often dwarfed by the catastrophic potential loss of a failed unconventional decision, demotion, public humiliation, getting fired. The phrase, "nobody ever got fired for buying IBM," perfectly captures this dynamic. In the 1970s and 80s, choosing IBM for your company's IT needs was the default, safe choice. It might not have been the best or most cost-effective solution, but it was the conventional one. If the project failed, the decision-maker could say, "Well, we chose the industry leader, it wasn't my fault." The blame was diffused. But if you chose a small, innovative startup and it failed, the blame was entirely on you. You were the fool who took a stupid risk. The institutional imperative is the love child of these two psychological forces. Social proof tells a CEO what the normal action is, and career risk aversion tells them that straying from that normal action is a personally dangerous gamble. The result is a powerful gravitational pull towards mimicry. Companies launch new products not because of deep customer research, but because their rivals did. They enter new markets not because of strategic fit, in pursuit of real financial freedom for the business, but because it's the fashionable thing to do. This isn't a failure of intelligence. The people in these rooms are often brilliant. It's a failure of the psychological architecture of the organization, a system that incentivizes conformity over critical thinking. Buffett's genius is not that he is immune to these biases, no human is, but that he has spent a lifetime creating systems and mental models to counteract them, to force a rational, independent analysis when the primal brain is screaming, "Follow the herd." So how do we fight back against these powerful, ingrained psychological forces? We can't simply will ourselves to be better. We need a specific tool, a repeatable process that forces logic to the forefront. Buffett's method can be distilled into a practical mental model we can call the independent premise filter. This is the blueprint for making decisions based on their intrinsic merit, completely stripped of the contaminating influence of what others are doing. It's a powerful algorithm for independent thinking. It consists of 5 distinct steps. Step 1. Clearly and honestly articulate the proposed action and the true reason behind it. Don't use corporate jargon. Write it down in plain language. For example, we are proposing to acquire Company X for $5 billion. Then, ask the critical follow-up. Why, really? The first answer is often a rationalization. You have to dig deeper. The honest answer might be, because our two main competitors, Company Y and Company Z, have both made large acquisitions in this space in the last 6 months, and we feel pressure from the board and Wall Street to make a move. Step 2. Isolate the premise. Every decision has an underlying belief or premise. In this case, the premise is, making an acquisition in this space is the correct strategy because our peers are doing it. By isolating the premise, you expose it. You can see it for what it is, a pure appeal to social proof. The entire justification rests on the actions of others. Step 3. Purge the social proof and reframe the question. This is the most crucial step. You must now conduct a thought experiment. Imagine you are operating in a total vacuum. No one else has made a similar acquisition. There is no news, no analyst pressure. You are the very first person to even consider this idea. Now reevaluate the action based solely on its own economic and strategic merits. The question is no longer, should we keep up with the competition? The question becomes, is paying $5 billion for this specific company, with its specific cash flows and its specific market position, a good use of our shareholders' capital that will generate a satisfactory return over the next 10 years? This reframing changes everything. It forces you to look at the business itself, not the noise surrounding it. Step 4. Quantify the independent merit. Now that you have the right question, you must answer it with numbers, not narrative. This is where the hard work of business analysis and corporate finance comes in. What is the intrinsic value of Company X? Project its future cash flows and discount them back to the present. What is a reasonable price to pay? What are the real synergies, and what is their quantifiable financial impact? How will this acquisition affect our balance sheet and return on invested capital? This is the work Buffett does. He doesn't care what other analysts think a company is worth. He does his own work to determine what it's worth to him. The output of this step should be a cold, hard number or a range of values. Step 5. Make the decision based only on the output of Step 4. Compare the price you have to pay, $5 billion, with the independent value you calculated. If the price is significantly below your calculated value, the deal makes sense. If it's above it, you walk away. The actions of your competitors become completely irrelevant. They are noise, not signal. By rigorously applying this five-step filter, you systematically dismantle the institutional imperative. You force your decision-making process out of the emotional, imitative part of your brain and into the analytical, rational part. This is a disciplined practice. It takes effort. The pull of the herd is strong. But this mental model serves as an anchor of logic in a sea of social pressure. It is the core of a true CEO mindset, focused on long-term value creation rather than short-term perception management. It's not about being a contrarian for the sake of it. It's about being an independent thinker, because it is the only path to superior results. To truly appreciate the wisdom of Buffett's approach, we must spend some time examining its opposite. We must walk the path of the 99%, the path paved by the institutional imperative, and see where it leads. It is a world of frantic activity, consensus-driven strategy, and ultimately devastating value destruction. Let's paint a picture of the typical executive or fund manager caught in this trap. Their world is not governed by first principles, but by a constant, anxious monitoring of their peers. Their primary source of information isn't deep industry analysis or direct customer feedback. It's competitor press releases, industry trade publications, and the pronouncements of Wall Street analysts. Their day is a series of meetings where the first slide in every presentation is the competitive landscape, showing what every other company in the space is doing. The conversation is dominated by phrases like, "We can't afford to be left behind," or "We need to have a story for the street." The goal is not to be right, but to be defensible. The worst possible outcome is not making a bad decision, but making a decision that is uniquely bad. A shared failure is acceptable. A lonely one is career suicide. This mindset inevitably leads to waves of corporate faddism. Consider the great conglomerate craze of the late 1960s. The prevailing wisdom, the institutional imperative of the day, was that professional management could run any business. The path to growth and a higher stock price was to acquire companies in completely unrelated industries. An electronics company would buy a rental car agency. A tobacco company would buy a food processor. The CEOs of these firms, like Harold Janine of ITT, were celebrated as geniuses on the covers of magazines. The herd mentality took over. If your rival was buying 10 companies a year, you were under pressure to do the same. The analysis became secondary to the activity. The result was a disaster. These sprawling, unfocused empires became bureaucratic nightmares, impossible to manage. The promised synergies never materialized. They were engaging in what Buffett would later call diversification, diversifying for the sake of it, and in the process making the core business worse. When the market turned in the 1970s, these bloated conglomerates came crashing down, destroying billions in shareholder value and taking decades to unwind. The executives who built them were not stupid. They were victims of an idea that became so popular, so universally accepted, that no one stopped to apply the independent premise filter. They never asked, if no one else were doing this, would it still make sense for a cigarette company to own a pizza chain? The same pattern repeats again and again with different labels. In the 1980s, it was the leveraged buyout craze. In the late 1990s, every company, no matter how mundane, had to have a .com strategy and an e-commerce division, most of which were quietly shut down a few years later, after burning through mountains of cash. More recently, we've seen waves of companies rushing into blockchain, AI, or other trendy technologies, often with no clear idea of how it fits their core business strategy, simply because they are afraid of looking old-fashioned. This is the path of the 99%. It is a path of reaction, not action. It is a path of chasing trends, not setting them. It is a frantic dance to the music of the market, a desperate attempt to stay in the middle of the dance floor where it feels safest. But as Buffett knows, the middle of the floor is where you get trampled when the panic starts. True success, lasting success, is found on the edges, where the crowd isn't looking, and where independent thinking is your only guide. The consequences of succumbing to the institutional imperative are not abstract. They show up in the cold, hard numbers of a company's financial statements and an investor's brokerage account. This way of thinking, this herd mentality, has a direct and quantifiable financial connection that systematically destroys wealth over the long term. Let's first look at a company's balance sheet. When a CEO gets caught up in a merger and acquisition frenzy, driven by the need to keep up with competitors, they almost invariably overpay. The bidding war for the hot asset of the moment drives the price far beyond its intrinsic value. When the deal closes, the acquiring company has to account for this overpayment. The price paid above the fair market value of the target's tangible assets is recorded on the acquirer's balance sheet as an intangible asset called goodwill. In the short term, this can look fine. The CEO gets to announce a big, transformative deal. But goodwill is a ticking time bomb. It must be tested for impairment every year. When it becomes clear that the acquired company is not going to generate the rosy cash flows that were projected to justify the high purchase price, the company is forced to take a goodwill write-down. This is an admission that they overpaid, that they destroyed shareholder capital. This write-down flows directly through the income statement as a massive expense, often wiping out years of net income in a single quarter. The AOL-Time Warner merger in 2000 is the textbook example. AOL, the darling of the dot-com bubble, acquired Time Warner in a deal driven by the new economy narrative. A year later, the company took a goodwill impairment charge of nearly $100 billion, one of the largest in corporate history. That is a direct financial quantification of the institutional imperative's destructive power. Beyond acquisitions, the imperative to mimic also leads to bloated corporate structures. If the standard in your industry is to have a sprawling headquarters with layers of middle management and a host of vice presidents for every conceivable function, the pressure to conform is immense. This leads to massive overhead costs, a direct drain on profitability that shows up on the income statement every single quarter as SG&A, selling, general, and administrative expenses. Buffett's own company, Berkshire Hathaway, stands in stark contrast. Its famously tiny headquarters in Omaha is a physical manifestation of his rejection of this imperative. The financial result is a lean, cost-efficient operation where more of every dollar of revenue flows down to the bottom line. For an investor, the financial connection is even more direct. Following the herd means you are systematically buying what is popular and expensive and selling what is unpopular and cheap. This is a mathematically guaranteed path to underperformance. The closet indexing mutual funds Buffett identified in the 1960s are a perfect illustration. An investor in such a fund pays active management fees, a direct reduction of their return, in exchange for what is essentially a passive, market-tracking portfolio. It's a transfer of wealth from the investor to the fund manager, who is being paid handsomely for the service of protecting their own career by not straying from the herd. The institutional imperative is, in financial terms, a tax on independent thought. It's a friction, a drag, a headwind that constantly works against long-term value creation. By understanding this connection, you can start to see it everywhere. In the foolish acquisition that destroys a balance sheet, in the bloated cost structure that stifles profits, and in the investment portfolio that is doomed to mediocrity. Resisting it is not just a philosophical stance. It is a direct and powerful financial strategy. The first pillar of our defense is now clear. We must identify and reject the institutional imperative. But this is often a passive act, a decision not to do something. The second, and perhaps more challenging pillar, involves active, courageous inaction. It is the wisdom to do nothing when every fiber of your being, every external pressure, is screaming at you to act. This is the courage of inaction, the ability to resist the siren song of activity that so often lures investors and corporations onto the rocks. There is no greater story to illustrate this principle than Warren Buffett's steadfast refusal to participate in the single greatest speculative mania of his lifetime, the dot-com bubble of the late 1990s. The context is essential to understand the sheer pressure he faced. From 1995 to early 2000, the stock market, led by technology and internet companies, was on a historic tear. Companies with no profits, no revenues, and sometimes no finished product were going public and achieving valuations in the billions of dollars overnight. It was a new paradigm, a new era, the experts proclaimed. Old metrics like price-to-earnings ratios were dismissed as relics of a bygone industrial age. The new valuation standard was price to eyeballs or price to clicks. A whole generation of new money billionaires was being minted. And in the middle of this frenzy sat Warren Buffett in Omaha, doing nothing. He was sitting on a mountain of cash, billions of dollars within Berkshire Hathaway. He watched as stock after stock with a .com at the end of its name doubled, tripled, and quadrupled, and he refused to buy. He was publicly and relentlessly mocked for it. The financial media, caught up in the euphoria, portrayed him as a dinosaur, a relic whose folksy wisdom about moats and value was hopelessly outdated in the new digital world. The most famous attack came in late 1999, when the influential financial magazine Barron's published a cover story with the headline, "What's Wrong, Warren?" The article detailed his underperformance and questioned whether the world's greatest investor had lost his touch. The pressure was immense. His own shareholders were questioning him. At the 1999 Berkshire Hathaway annual meeting, a shareholder stood up and pointedly asked why he was missing out on the easiest money-making opportunity in history. Buffett's response at that meeting is a masterclass in the courage of inaction. He didn't get defensive. He didn't try to predict when the bubble would burst. He calmly and simply explained that these technology companies were completely outside his, quote, circle of competence. He said he had no special insight into which of the hundreds of competing tech firms would be the long-term winners. He couldn't confidently project their cash flows 10 or 20 years into the future, and because he couldn't value them with any degree of certainty, he would not play the game. He admitted he might be wrong. He acknowledged that others were getting rich. But he would not be tempted into a game where he didn't understand the rules. This was the institutional imperative in full force. The imperative for any money manager at the time was clear. You had der starred to own tech stocks. To not own them was to risk massive underperformance and the loss of clients. It was a huge career risk. Every major mutual fund was piling in, afraid of being left behind. Buffett's decision to sit on the sidelines with his cash was a radical act of defiance. He chose to look like a fool in the short term to avoid being a casualty in the long term. And we all know how the story ended. In March of 2000, the bubble burst. The Nasdaq index, which had peaked above 5,000, collapsed. Over the next 2 years, it would lose nearly 80% of its value. Hundreds of dot-com companies went bankrupt. Trillions of dollars of speculative wealth vanished. And as the wreckage burned, Warren Buffett was still sitting in Omaha, with his mountain of cash intact. That cash was no longer a symbol of his stubbornness. It was a powerful strategic weapon, ready to be deployed into a market where assets were suddenly cheap again. His inaction, his willingness to endure the pain of missing out, was the very thing that preserved his capital and set the stage for his next decade of masterful investing. The immense pressure Buffett felt during the dot-com bubble, the urge to do something rather than nothing, is not just a market phenomenon. It stems from a powerful cognitive flaw known as the action bias. This is our brain's innate preference for action over inaction, even when inaction is the more rational course. On an evolutionary level, this makes perfect sense. For our ancestors on the savannah, the cost of inaction in the face of a potential threat was often death. It was almost always better to run from a shadow than to wait and see if it was a predator. This bias towards doing something, anything, is deeply embedded in our neural circuitry. In the modern world of investing and business, however, this same instinct is often catastrophic. We see the market moving, We see our competitors making acquisitions, and our brain screams at us to act. The discomfort of sitting still while others are seemingly profiting is immense. This feeling is colloquially known as FOMO, or fear of missing out. FOMO is the engine of speculative bubbles. It's a social contagion, the feeling that everyone else is getting rich and you're being left behind. It transforms investing from a rational exercise of calculating value into an emotional competition to not be the last one to the party. The action bias and FOMO work together as a powerful one-two punch against sound decision-making. FOMO provides the emotional fuel, the anxiety and greed, while the action bias provides the justification for immediate, often ill-considered activity. A day trader compulsively checking their screen and making dozens of trades a day is in the grip of the action bias. A CEO who rushes their company into a hot new sector without a clear strategy is being driven by FOMO. Warren Buffett's incredible discipline is a learned response, a system he has built to override these primal urges. His legendary patience is not a passive state, it's an active, ongoing process of resisting the brain's demand for action. He understands that in investing, activity is often the enemy of returns. Every trade has a cost, both in commissions and in the potential for making a mistake. He famously said that an investor should be given a punch card with only 20 punches on it for their entire lifetime. With each investment, you punch a hole. This mental exercise forces you to treat every decision with extreme seriousness, to wait for the truly extraordinary opportunities, the fat pitches, rather than swinging at every ball that comes over the plate. This is the psychological opposite of the hyperactive trader or the fad-chasing CEO. It is a profound recognition that sometimes the most profitable, most strategic, and most intelligent move you can make is to do absolutely nothing. It is the understanding that capital is precious and the opportunity to deploy it is not a right, but a privilege to be exercised with extreme selectivity. Overcoming the action bias requires more than just willpower. It requires building a framework, a set of rules that pre-commit you to patience. It is about transforming the psychological pain of missing out into the intellectual pleasure of exercising discipline and waiting for the perfect moment to strike. How can we, in our own professional lives, cultivate this Buffett-like patience? We need a practical tool, a mental model that serves as a bulwark against the tide of FOMO and the action bias. This blueprint is called the Circle of Competence Mandate. It is not just an idea. It is a hard and fast operational rule for decision-making under pressure. It's a system for institutionalizing the courage of inaction. There are 4 steps to implementing this mandate. Step 1. Define your circle of competence with brutal, unflinching honesty. This is not a time for ego. Take out a piece of paper and write down the industries, business models, technologies, and financial instruments that you understand deeply. Not just what you've read about, but what you understand on a granular level. Could you explain the competitive dynamics of this industry to a child? Could you intelligently debate its future with a leading expert? Your circle might be small. It might be just one industry, or even one niche within an industry. That's fine. The size of the circle is not important. Knowing its boundaries is everything. Buffett himself admits his circle is small. He understands consumer brands, insurance, and banking. He has historically not understood technology, which is why he stayed away. Honesty in this step is the foundation for everything that follows. Step 2. Create an unbreakable rule. You are forbidden from making any major investment or strategic decision outside of your defined circle of competence. No exceptions. It doesn't matter how popular the trend is, how much money your friends are making, or how much pressure you're under. If an opportunity falls outside the circle, the analysis stops immediately. The decision is already made. Do nothing. This is not a suggestion. It is a mandate. This rule acts as a pre-commitment. You make the decision in a moment of calm rationality, to not trust your own judgment in moments of high emotion and temptation. Step 3. Rechannel your energy. The time and mental energy you save by automatically saying no to opportunities outside your circle should be reinvested. Use this time not to chase trends, but to deepen your understanding within your existing circle. Read more annual reports of the companies you know. Talk to more customers in your industry. Become the world's leading expert on your small patch of ground. Buffett spends the vast majority of his day reading, not trading. He is constantly deepening his circle, not trying to expand it into areas he doesn't understand. True expertise is built on depth, not breadth. Step 4. Prepare your shopping list in advance. During these times of patient study, you should be identifying the truly great businesses within your circle of competence. These are the companies you would love to own, but which are currently too expensive. Create a dream portfolio and, more importantly, calculate the price at which you would be thrilled to buy each of them. This is your pre-prepared shopping list. Now you are no longer passively waiting, you are actively hunting. You are waiting for the market, in its periodic fits of panic or neglect, to offer you one of your dream businesses at your dream price. The Circle of Competence mandate fundamentally changes your orientation to the market and to business strategy. It transforms you from a reactive participant, swayed by the latest fad, into a disciplined professional who operates only on their own terms. It is the ultimate defense against the fear of missing out, because you're not missing out on anything you truly understand. You are simply letting the pitches you can't hit go by, waiting patiently for that perfect slow fastball right down the middle of your circle. And when it comes, you will have the confidence and the capital to swing for the fences. The path of the 99% is the polar opposite of this disciplined patience. It is a path of frantic, constant, and ultimately self-defeating activity. The average investor or CEO who lacks the Circle of Competence mandate is like a ship without a rudder, tossed about by the waves of market sentiment and media hype. Their actions are not driven by a coherent, long-term business strategy, but by a desperate need to keep up with the news cycle. Imagine the typical day trader. They start their morning not by reading a 10K report, but by watching the pre-market chatter on a financial news channel. They see a stock is in play because of an earnings announcement or a vague rumor. They feel the twitch of the action bias. They jump in, buy the stock only to see it reverse a few minutes later. They panic, sell for a small loss, and then watch as another stock starts to move. They chase it. They repeat this cycle throughout the day, churning their own portfolio, racking up transaction costs, and making emotional decisions based on meaningless, short-term price fluctuations. They are playing a loser's game, mistaking activity for progress and volatility for opportunity. Now translate this behavior to the corporate world. The antithesis of Buffett is the hyperactive CEO. This is the executive who is obsessed with making things happen. They cannot tolerate a quarter without a major announcement, a transformative acquisition, a corporate restructuring, or a bold new strategic initiative. They are often celebrated by the business press as visionaries and disruptors. But often, this constant motion is just a sign of strategic incoherence. A prime example is the corporate rush to rebrand or pivot for a stock price pop. In the late 1990s, dozens of ordinary companies, from iced tea makers to furniture retailers, simply added .com to their corporate name and saw their stock prices soar, despite no fundamental change to their business. More recently, we have seen the same phenomenon with companies suddenly announcing a pivot to blockchain or developing an AI strategy. This is not strategy, it is marketing. It is a desperate attempt to catch the wave of whatever narrative is currently captivating Wall Street. The financial consequences of this hyperactivity are devastating. For the investor, it is death by 1,000 cuts. The constant trading erodes capital through commissions and taxes. The emotional buying of hot stocks and panic selling of cold ones ensures that they buy high and sell low. For the corporation, the cost is even greater. Each failed strategic initiative, each overpriced acquisition made in a moment of FOMO, destroys real shareholder capital. It distracts the organization, demoralizes employees, and confuses customers. It is the business equivalent of chasing your own tail. The path of the 99% is seductive because it feels productive. Being busy, making trades, announcing deals, It all creates the illusion of progress. But Buffett's wisdom teaches us that progress in investing and business is not measured by the quantity of your decisions, but by their quality. The courage of inaction is the understanding that one great decision a year, or even a decade, is worth more than 1,000 mediocre ones. It is the discipline to wait for that one great decision, even if it means years of being called a dinosaur. The direct financial connection of this principle, the courage of inaction versus hyperactivity, is one of the most powerful and misunderstood forces in wealth creation. The financial advantage doesn't just come from avoiding mistakes, it comes from the immense strategic value of preserved capital. Let's first quantify the cost of hyperactivity for an investor. Studies have repeatedly shown that the more an individual investor trades, the worse their returns are. This is due to two primary factors: transaction costs and taxes. Every time you buy or sell a stock, you pay a commission. More importantly, if you hold a winning stock for less than a year, your profit is taxed as a short-term capital gain, which is taxed at a much higher rate than long-term gains. This constant drag on your portfolio acts like a financial headwind, making it incredibly difficult to compound wealth effectively. A hyperactive trader might need to generate a 10% gross return just to break even after costs and taxes, while a patient, long-term investor keeps almost all of their gains working for them. For a corporation, the financial impact is even more profound. Think of the cash on a company's balance sheet. A CEO, driven by the action bias, sees this cash as a problem to be solved, something that needs to be put to work immediately. This often leads to value-destructive behavior, buying back stock at inflated prices, making ill-advised acquisitions, or investing in low-return pet projects just to appear busy. Buffett, on the other hand, views his mountain of cash not as a liability, but as a priceless strategic asset. He calls it, quote, optionality. While his cash earns very little in the short term, its true value is not its yield, but its potential. It is dry powder. It is, in his words, a financial bazooka that he keeps ready for when the perfect opportunity presents itself. And when do those opportunities arise? They arise when the rest of the world is panicking, when the hyperactive players have exhausted their capital or are being forced to sell good assets to cover bad debts. During the 2008 financial crisis, when credit markets were frozen and even great companies like Goldman Sachs and General Electric were desperate for cash, who did they call? They called Warren Buffett. Because he had practiced the courage of inaction, he had the capital available to make incredibly lucrative, preferential deals that were not available to anyone else. He was able to extract terms, high interest rates, warrants to buy stock at low prices that generated billions in profits for Berkshire Hathaway. The financial value of that optionality, of having cash in a crisis, is almost impossible to overstate. It allowed him to buy assets at pennies on the dollar, turning the market's fear into his fortune. So the direct financial connection is twofold. On one hand, inaction saves you from the guaranteed wealth destruction of hyperactivity, the costs, the taxes, the bad decisions made in haste. On the other hand, it builds your single greatest strategic weapon, a reserve of capital that allows you to go on the offensive when everyone else is in forced retreat. Patience is not passive, it is the storing of power. Having established a defense against the institutional imperative and cultivated the courage of inaction, we now arrive at the third pillar. This is where the strategy shifts from defense to offense. It is not enough to simply avoid the mistakes of the crowd. True financial wisdom lies in actively exploiting the folly that the crowd's behavior creates. This is the contrarian offensive, the art of turning widespread fear and greed into generational wealth-building opportunities. Buffett's career is littered with examples of this, but perhaps none is more illustrative of the core principle than his investment in American Express during the Salad Oil scandal of 1963. It's a story that perfectly captures how a moment of intense, concentrated panic can create an unbelievable bargain for an investor with a clear head. The setup was this. American Express was a respected blue-chip company known for its travelers, checks, and charge cards. However, a significant, though non-core, part of its business was in warehousing. It operated a division that would issue receipts against goods stored in its warehouses, and these receipts were then used by businesses as collateral for loans. One of its largest clients was the Allied Crude Vegetable Oil Refining Corporation, run by a man named Tino De Angelis. In November 1963, a bombshell dropped. It was discovered that De Angelis was a fraud on a massive scale. His giant storage tanks in Bayonne, New Jersey, which were supposed to be filled with valuable salad oil, were mostly filled with seawater, with only a thin layer of oil floating on top to fool inspectors. Allied Crude Vegetable Oil immediately went bankrupt, defaulting on over $150 million in loans from major Wall Street banks, loans that were collateralized by now worthless warehouse receipts from American Express. The market panicked. The institutional imperative screamed with a single voice, "Sell!" The reasoning seemed sound. American Express had guaranteed the receipts. It was potentially on the hook for the entire fraud, a sum that was larger than the company's entire net worth at the time. The narrative was that the scandal had irreparably tainted the prestigious American Express brand. Wall Street analysts predicted bankruptcy. The stock, which had been trading at over $60 a share, collapsed, falling almost 50% in a matter of weeks to as low as $35. This was a moment of pure, unadulterated terror. But Warren Buffett, then running his small partnership in Omaha, did not panic. He saw the herd stampeding, and instead of joining them, he got curious. He engaged in what he calls scuttlebutt research. He didn't just read the panicked Wall Street reports. He went out to investigate the underlying reality of the business. He visited restaurants and banks. He talked to merchants and customers. He asked them a simple question. Were they still accepting American Express cards? Were they still using the travelers' checks? The answer, universally, was yes. He observed that the fear was completely contained to Wall Street. The average consumer and business owner either hadn't heard of the salad oil scandal or didn't connect it to the charge cards in their wallet. He realized the core business, the powerful consumer brand that generated the company's real profits, was completely unharmed. The warehousing division was a peripheral issue. He did the financial analysis and concluded that even in a worst-case scenario, the company's liability was manageable, and that its powerful earning power was being valued at a ridiculously low price. Convinced of his analysis, Buffett acted decisively. He invested 40% of his entire partnership's capital into American Express stock. It was a massive, highly concentrated bet. Over the next few years, as the company settled the legal issues and the market realized the core brand was as strong as ever, the stock soared. The investment was a grand slam, generating huge returns for his partners and helping to build the foundation of his fortune. This story is the perfect encapsulation of the contrarian offensive. It is about using the market's extreme emotion as a signal to look deeper, to separate a temporary, solvable problem from a permanent impairment of a great business. While the herd was selling based on a scary headline, Buffett was buying based on fundamental reality. The panic that engulfed American Express stock in 1963 is a textbook example of several powerful cognitive biases at work, but two stand out: loss aversion and the affect heuristic. Understanding these psychological triggers is key to understanding why the herd behaves the way it does, and how a rational investor can take the other side of their emotional trades. Loss aversion, as we've touched on, is the principle that the pain of a loss is felt much more intensely than the pleasure of an equivalent gain. When the salad oil scandal broke, investors holding American Express stock weren't thinking about the future potential gains. They were consumed by the terrifying, immediate prospect of loss. The fear of the stock going to zero was so powerful that it overwhelmed any rational calculation of the company's long-term value. This feeling creates a powerful urge to sell now, to stop the pain, regardless of the price. It's a flight response, not an investment decision. When an entire market is in the grip of loss aversion, you get a panic. Prices become detached from value. driven not by analysis of future cash flows, but by the raw, primal emotion of fear. The second bias at play is the affect heuristic. This is a mental shortcut where people make judgments based on their current emotional state. If a subject like the salad oil scandal evokes a strong negative emotion, fear, disgust, anger, then people's judgment about the risks and benefits of that subject will be clouded by that emotion. The word fraud is an incredibly powerful emotional trigger. When it became associated with American Express, it created a negative affect. Investors felt bad about the company. This feeling led them to subconsciously overestimate the risks. The company will go bankrupt, and underestimate the benefits. The core brand is still incredibly profitable. They were reacting to the emotional label of scandal-plagued company rather than the business reality. Buffett's superpower is his ability to remain emotionally detached. He doesn't see a scary story. He sees a set of facts and figures. His scuttlebutt research was a deliberate process to replace the emotional narrative of the market with cold, hard data from the real world. Were people still using the cards? Yes, that was a fact. The market's feeling of fear was an opinion. He chose to base his decision on the fact, not the opinion. The contrarian offensive is, at its core, a form of psychological arbitrage. You are exploiting the predictable emotional overreactions of others. When the market is gripped by fear, you know that loss aversion and the affect heuristic are likely causing investors to sell assets for far less than they are worth. Their emotional state creates a pricing error in the market. Your job as a rational investor is not to get caught up in their emotion, but to identify that pricing error and capitalize on it. This requires more than just a strong stomach. It requires a deep understanding of these psychological pitfalls. You have to recognize them in others, and, more importantly, build systems to prevent them from clouding your own judgment. This is the intellectual foundation of the famous Buffett maxim: be fearful when others are greedy, and greedy only when others are fearful. It's not just a clever phrase. It's a direct operational command to act as the counterparty to the market's most powerful and predictable psychological biases. To systematically exploit the emotional swings of the market, you need more than just a contrarian attitude. You need a tool, a framework that translates the principle of "be greedy when others are fearful" into a concrete, actionable plan. This mental model is the Fear and Greed Barometer. It's a system for using market sentiment not as something to be feared or followed, but as a direct, actionable buy or sell signal. This blueprint has 5 steps. Step 1. Create your personalized sentiment dashboard. Your goal here is to objectively measure the level of fear and greed in the market. You'll gather a handful of key indicators that, when viewed together, paint a picture of the collective mood. These could include the VIX index, often called the fear gauge, which measures expected market volatility, the AAII Investor Sentiment Survey, which asks individual investors if they are bullish, bearish, or neutral, the CNN Fear and Greed Index, which combines multiple indicators into one reading, and qualitative indicators like the number of fawning magazine covers featuring celebrity CEOs or the frenzy in the IPO market. You don't need dozens of indicators. Pick 3 to 5 that you understand and can track easily. Step 2. Define your action zones. Based on historical data for your chosen indicators, you need to define what constitutes maximum fear and maximum greed. For example, you might decide that a VIX reading above 40, combined with a bearish reading of over 50% on the AAII survey, officially places your barometer in the maximum fear zone. Conversely, a VIX below 15 and extreme bullish sentiment might define your maximum greed zone. Write these definitions down. They are the rules of your system. Step 3. Prepare your shopping list during times of calm. This is a crucial step that must be done when the market is placid and your thinking is clear. This is when you do your fundamental research, identifying the high-quality businesses within your circle of competence that you would love to own at the right price. This is the shopping list we discussed earlier. For each company on the list, you determine a buy price, the price at which you believe the stock offers a significant margin of safety and a high probability of attractive long-term returns. Step 4. Let the barometer trigger your actions. The system is now in place. Your job is to follow its signals, overriding your own emotional instincts. When your barometer enters the maximum fear zone, the rule is you must start buying. The feeling of fear in your gut, the terrifying headlines, the plunging stock prices, these are no longer signals to sell. They are now your official, system-mandated buy signals. You consult your pre-prepared shopping list and start deploying capital into those great businesses as they hit your target prices. Conversely, when your barometer enters the maximum greed zone, when euphoria is rampant and your taxi driver is giving you stock tips, your system tells you it's time to trim positions, sell anything that has become grossly overvalued, and raise cash. Step 5. Trust the process. This is the hardest part. The barometer will force you to buy when every bone in your body wants to sell, and to sell or stand aside when it feels like the easiest money in the world is being made. You must have the discipline to trust the system you built in a moment of rationality over the emotions you feel in a moment of market madness. The Fear and Greed Barometer is a powerful tool for implementing a contrarian investing strategy. It systematizes the process of going against the herd. It provides an objective framework that helps you lean against the winds of market psychology, buying pessimism and selling optimism. It is the practical application of Buffett's core insight. The crowd's emotions are not a source of information about the future, but a source of opportunity in the present. The path of the 99% is to be a slave to market emotion, not its master. For the average investor, fear and greed are not signals to be analyzed, they are commands to be obeyed. Their journey through a market cycle is a predictable and painful roller coaster of emotional reactions that systematically destroys their wealth. Let's trace this path during a major market crash, like the 2008 financial crisis. As the crisis began to unfold with the collapse of Lehman Brothers, the initial reaction was disbelief, followed by rising anxiety. The headlines grew more dire. The nightly news showed images of worried traders on the floor of the stock exchange. The average investor, looking at their 401k statement, saw the value begin to drop. Their feeling of loss aversion began to kick in. Their friends and colleagues started talking nervously about the market. The social proof was all pointing in one direction. Things are getting scary. Then, the real panic set in. The market began to drop precipitously. The feeling of anxiety turned into pure terror. The investor's mental state was now completely governed by the affect heuristic. The market was a source of pain and fear. The only thought was, I have to get out before it goes to zero. They call their broker or log into their account and sell everything, often near the absolute bottom of the market in late 2008 or early 2009. They sell not because of a rational analysis of the long-term earning power of the companies in their portfolio, but because the emotional pain of seeing their account value decline further was unbearable. In that moment, selling provides a feeling of relief. They have stopped the bleeding. They have taken control. But what they have actually done is turn a temporary paper loss into a permanent catastrophic loss of capital. They have locked in their losses at the point of maximum pessimism. Now, the aftermath. The market eventually bottoms and begins a slow, tentative recovery. But the average investor is too traumatized to get back in. They are suffering from recency bias, where their recent painful experience dominates their view of the future. They believe the market is too risky, that it's a sucker's rally. They wait, and they wait. They wait for things to feel safe again. By the time the market has recovered significantly, when the headlines are positive again and the feeling of fear has subsided, they finally feel comfortable enough to reinvest. But by now they are buying back the same assets they sold at the bottom, only at a much higher price. They have perfectly executed the strategy of buy high, sell low. This is not an indictment of their intelligence. It is a testament to the overwhelming power of market psychology when an individual has no framework or system to protect them. They are a leaf in the wind, and the wind is the collective emotion of the herd. The path of the 99% is paved with emotional decisions, and it leads directly to the graveyard of financial goals. The financial advantage of executing a contrarian offensive, powered by a tool like the Fear and Greed Barometer, is not just significant, it is exponential. It is the primary engine of the outsized returns that legends like Buffett have generated over their careers. The core concept is mathematical and profound. The price you pay for an asset determines your ultimate rate of return. Let's illustrate this with a simple example. Imagine a great, stable company. Let's call it Quality Company. In a normal market, Quality Company earns $5 per share and its stock trades at $100, a price-to-earnings ratio of 20. You believe this is a fair price, but not a bargain. Now, a market panic ensues. The herd, gripped by fear, sells indiscriminately. The stock of Quality Company gets dragged down with everything else, falling 50% to $50 per share. Let's assume the company's underlying business is only slightly affected, and its earning power only temporarily drops to $4.50 per share. The institutional imperative is screaming sell, but your fear and greed barometer is flashing buy. You step in and purchase shares at $50. Now, let's look ahead a few years. The panic subsides, the economy recovers, and Quality Company mess earnings return to their normal $5 per share. The market sentiment becomes rational again, and the stock price returns to its fair value of $100. For the investor who held on through the panic, their asset is back to where it started. They've made no money. For the investor who panicked and sold at $50, they've locked in a 50% loss. But for you, the contrarian, your $50 investment is now worth $100. You have doubled your money, a 100% return. Your return was not generated by any special genius in predicting the future, but simply by having the liquidity and the fortitude to act when prices were divorced from reality. This is the concept of margin of safety, a term coined by Buffett's mentor, Benjamin Graham. By buying at $50, you bought the company for far less than its intrinsic value. This large gap between price and value was your margin of safety. It provided both downside protection and massive upside potential. The financial connection gets even more powerful. Because you bought at a lower price, your ongoing yield is higher. When Quality Company is paying a $2 annual dividend, the investor who bought at $100 gets a 2% yield. You, who bought at $50, receive a 4% yield on your original investment. Your capital works harder for you forever. Over an entire investment lifetime, consistently applying this contrarian approach has a staggering effect. While the herd is achieving mediocre, market-like returns, diminished by their panicked selling at the bottoms, the contrarian is harvesting alpha from those very panics. They are systematically transferring wealth from the impatient and emotional to the patient and rational. This is the direct financial manifestation of exploiting the folly of the crowd. It is how fortunes are made not by timing the market, but by taking advantage of its predictable and recurring bouts of insanity. We have now established the external pillars of Buffett's system, rejecting the institutional imperative, embracing inaction, and exploiting the crowd's folly. But for these strategies to be sustainable, they must be built on a solid internal foundation. This brings us to our fourth pillar, building an institutional moat. It's not enough for an individual leader to be an independent thinker. They must create an entire corporate culture, a system, that is itself immune to the pressures of groupthink and the institutional imperative. This is about designing an organization that inherently promotes rational decision-making and independent thought. The greatest case study for this is Berkshire Hathaway itself. The company's structure and culture are a deliberate and radical rejection of the standard corporate model. To understand this, one must contrast the physical reality of Berkshire's headquarters with that of a typical Fortune 500 company. Most large corporations reside in gleaming skyscrapers, sprawling corporate campuses filled with thousands of employees. There are layers of management, complex hierarchies, and a culture dominated by meetings, presentations, and consensus building. Berkshire Hathaway's world headquarters, by contrast, occupies a single floor in a modest office building in Omaha, Nebraska. The total number of employees at headquarters is around 24. This is the nerve center of a company worth over $500 billion, one of the largest corporations in the world. This tiny headquarters is not an accident or a quirk, it is the physical embodiment of a deep philosophy. Buffett has designed Berkshire to be the antithesis of a bureaucracy. The core model is one of extreme decentralization. Berkshire owns dozens of subsidiary companies, from Geico Insurance to Dairy Queen to BNSF Railway. Each of these companies is run by a CEO who has almost complete operational autonomy. Buffett and his partner, Charlie Munger, do not meddle. They do not hold endless strategy meetings. They do not demand PowerPoint presentations. Their primary job is not to manage the businesses, but to allocate the capital that the businesses generate. One of the most famous anecdotes that illustrates this culture is the acquisition of the Nebraska Furniture Mart in 1983. The company was founded by an indomitable Russian immigrant, Rose Blumkin, known universally as Mrs. B. She had built it from a pawn shop into the largest home furnishing store in North America. Buffett wanted to buy the company. The negotiation consisted of a short meeting. He asked her what the price was. She gave him a number. He said yes. There were no armies of lawyers or investment bankers performing months of due diligence. The entire deal was based on a simple, 2-page contract and a handshake. He trusted Mrs. B implicitly to continue running the business exactly as she had before. He didn't want to change it. He wanted to buy it and get out of the way. This hands-off approach creates a culture of ownership, not management. The CEOs of Berkshire's subsidiaries are not corporate bureaucrats playing a game of internal politics. They are entrepreneurs running their own show. This structure serves as a powerful moat against the institutional imperative. Because there is no large central bureaucracy, there is no culture of groupthink to begin with. Decisions are not made by committee. They are made by accountable individuals who have deep knowledge of their specific business. There is no pressure to copy a competitor's strategy because the CEO of See's Candies is not judged against the performance of the CEO of BNSF Railway. They are judged on their own merits. This institutional design is Buffett's masterwork. He has built a corporation that is structurally resistant to the very forces he has spent his life criticizing. The bureaucratic, centralized structure of the typical large corporation is a breeding ground for two of the most destructive forces in business: groupthink and the principal-agent problem. Buffett's decentralized model at Berkshire is a direct antidote to both. Groupthink is a psychological phenomenon, first identified by social psychologist Irving Janis, that occurs within a group of people in which the desire for harmony or conformity results in an irrational or dysfunctional decision-making outcome. In a groupthink environment, dissenting opinions are discouraged, and there is pressure to align with the consensus view, which is often the view of the most powerful person in the room. Think of a typical corporate strategy meeting. A dozen executives are in a boardroom. The CEO presents a bold new initiative. A few of the most senior executives quickly voice their support. At this point, it becomes very difficult for a more junior executive to raise concerns. To do so would be to rock the boat, to appear not to be a team player. They suppress their own doubts and conform to the group. The result is what Janis called a deterioration of mental efficiency, reality testing, and moral judgment. The group collectively makes a decision that few of the individuals, if thinking alone, would have endorsed. Berkshire's structure short-circuits this entirely. There are no big strategy meetings. The CEO of Benjamin Moore Paints doesn't need to conform to the opinion of the CEO of NetJets. They operate in separate spheres, each focused on their own reality. This fosters true independent thinking. The second psychological problem that plagues most corporations is the principal-agent problem. In business, the shareholders are the owners, or principals. The executives and managers they hire to run the company are the agents. The problem arises because the interests of the agents are not always perfectly aligned with the interests of the principals. An agent might be more concerned with their own salary, job security, and reputation than with maximizing long-term shareholder value. This misalignment leads to all sorts of value-destructive behavior. For example, a CEO might push for a large acquisition not because it's a great investment for shareholders, but because running a larger empire is more prestigious and comes with a bigger paycheck. This is a classic manifestation of the institutional imperative, driven by the agent's self-interest. Buffett's solution to the principal-agent problem is radical and effective. First, by giving his CEOs extreme autonomy, he treats them like principals, not agents. They are true owners of their business's destiny. Second, he aligns their incentives directly with the principals. The compensation for many Berkshire CEOs is tied directly to the performance of their specific business unit, not the overall performance of Berkshire's stock. They are rewarded for running their own operation superbly, which is what the shareholders, the ultimate principals, truly want. This combination of autonomy and aligned incentives creates a powerful culture of accountability and meritocracy. It strips away the bureaucracy and the internal politics that plague so many large organizations, allowing talented managers to focus on what they do best: running their businesses. It is a system designed by a master psychologist, built to harness the best of human motivation while defending against its worst cognitive pitfalls. So how can a leader who is not Warren Buffett apply these principles to their own organization? The blueprint for building an institutional moat can be called the decentralized ownership framework. It is a set of rules for designing a company that is resistant to groupthink and focused on rational, long-term value creation. It's a prescription for leadership and business strategy. Step 1. Radically shrink your central headquarters. This is both a symbolic and a practical first step. A bloated headquarters is the physical home of bureaucracy. By drastically reducing its size and scope, you send a clear message. Value is created in the operating businesses, not in the central office. Eliminate layers of middle management whose primary job is to review the work of others. Push power and decision-making authority away from the center and out to the front lines. Step 2. Organize into autonomous, accountable business units. Break your company down into its smallest logical components. Each unit should have a clear mission, its own profit and loss responsibility, and a single leader who is in charge. The goal is to create a federation of small, nimble businesses rather than a single, monolithic hierarchy. This structure fosters a sense of ownership and clarity that is impossible in a complex, matrixed organization. Step 3. Hire for trust and then give it unconditionally. Find leaders for your business units who you believe in not just as managers, but as partners. Look for people with deep integrity, a passion for their business, and a shareholder-oriented mindset. And once you hire them, get out of their way. Give them the authority to make their own decisions, to succeed or fail on their own merits. Your relationship should be one of a capital allocator to an operator, not a boss to a subordinate. Step 4. Define your role as Chief Capital Allocator. As the leader of the parent company, your primary job is not to meddle in the day-to-day operations of the subsidiaries. Your job is to make two critical decisions: who to put in charge of each unit, and how to allocate the capital that the units generate. The cash should flow from the subsidiaries up to the corporate level, where you can then decide to reinvest it in the most promising opportunities across the entire organization, or return it to shareholders. This is the essence of what Buffett and Munger do. They are masters of corporate finance and capital allocation, not micromanagers. Step 5. Communicate with clarity and brevity. Abolish the culture of endless meetings and PowerPoint decks. Communication should be direct, honest, and focused on results. Buffett famously asks his CEOs to send him a letter once a year, telling him what they think he needs to know. He has a simple rule: no budgets are to be sent to headquarters. He trusts his managers to run their businesses efficiently without his oversight. This radical simplicity frees up everyone in the organization to focus on their real jobs, rather than on the performative theater of corporate bureaucracy. Implementing this framework requires immense courage. It means giving up control. It means resisting the urge to build an empire at the center. But the reward is an organization that is faster, more efficient, more innovative, and far more resistant to the institutional imperative than its centralized competitors. It is a company built for the long term. The path of the 99% is the path of bureaucracy. It is the default model for nearly every large organization in the world, and it is a path that almost inevitably leads to mediocrity and sclerosis. Let's walk through the life of a decision inside a typical, centralized corporation. An idea is born, perhaps in a mid-level manager's mind. To get it approved, they must first create a detailed PowerPoint presentation. This presentation then has to be reviewed by their direct boss, then their boss's boss. It gets put on the agenda for a series of committee meetings, where representatives from finance, marketing, legal, and operations all get to weigh in, each adding their own concerns and modifications. The original, clear idea becomes muddled and compromised, designed by a committee to offend no one. To get final approval, the decision often requires the hiring of an expensive outside consulting firm. This is a crucial part of the ritual. The consultants will spend months conducting studies and generating a 300-page report that, in essence, validates the decision the executives were already leaning towards. The purpose of the consultants is not to provide genuine insight, it is to provide air cover. If the decision turns out to be wrong, the executives can say, "Well, we hired the world's leading consulting firm. We followed best practices." It is a classic exercise in the diffusion of responsibility. This entire process is slow, expensive, and soul-crushing for any employee with a genuinely innovative idea. It actively discourages risk-taking and independent thinking. The safest and easiest path to career advancement in such a system is not to rock the boat, to go along with the consensus, and to master the art of navigating the internal bureaucracy. This environment is the perfect petri dish for the institutional imperative to fester. When decisions are made by large, risk-averse committees, the most comfortable choice is always to copy what your successful competitors are doing. They're doing it, so it must be a good idea, becomes the unspoken logic. This leads to entire industries looking and acting the same. Think of the banking industry before 2008, where every major bank was buying and packaging the same subprime mortgages, not because each one independently concluded it was a brilliant strategy, but because it was what everyone else was doing. The herd mentality was reinforced by the internal bureaucratic structures that rewarded conformity and punished dissent. This is the antithesis of the Berkshire model. It is a system that optimizes for defensibility rather than for results. It is a world of CYA, cover-your-ass emails, of endless meetings about meetings, of political maneuvering for resources. And it is a world that Warren Buffett has spent his entire life avoiding and building an organization designed to repel. The financial connection between Buffett's decentralized, ownership-driven culture and Berkshire's staggering long-term success is direct and undeniable. The cost of bureaucracy and the benefit of efficient capital allocation are two of the most powerful, yet often overlooked, drivers of corporate value. First, let's consider the direct costs of the bureaucratic model. The sprawling corporate headquarters, the layers of management, the armies of consultants. These all represent a massive overhead expense that is a direct drag on the company's income statement. This is money that is being spent not on creating products or serving customers, but on internal administration and process. Berkshire's lean headquarters means that more of every dollar of revenue generated by its subsidiaries can be kept within the company, ready to be reinvested. This cost advantage, compounded over decades, becomes enormous. But the more significant financial advantage comes from superior capital allocation. In most large companies, capital allocation is a highly political process. The different divisions of the company fight for their share of the annual budget. Money is often reinvested into a division not because it offers the highest potential return, but because its leader is the most powerful political operator. A mediocre business might continue to receive capital for years simply out of inertia. This is a recipe for the slow destruction of shareholder value, as good money is thrown after bad. Berkshire's model is a ruthlessly rational and efficient capital allocation machine. The cash from all the disparate businesses flows to the top. Buffett and Munger then sit as dispassionate judges, with no emotional attachment to any single division. Their only question is, Where can this new dollar of capital be deployed to generate the highest possible long-term return? Sometimes the answer is to reinvest it back into one of their existing businesses. Sometimes it's to buy a new business. Sometimes, if no attractive opportunities exist, it's to simply let the cash pile up and wait. This is a crucial point. Unlike a typical CEO who feels pressure to constantly reinvest, Buffett is perfectly happy to do nothing if the prices aren't right. This discipline prevents him from deploying capital into low-return projects just for the sake of activity. This superior capital allocation process is the true secret sauce of Berkshire Hathaway. It is the engine that has driven its compounding machine for over 50 years. The company's unique institutional structure, its moat against bureaucracy and groupthink, is what makes this rational capital allocation possible. It is a system designed for one purpose: to take the cash generated by a diverse set of good businesses and reinvest it in an intelligent, shareholder-focused way. This direct financial connection, low overhead costs combined with hyper-efficient capital allocation, is the ultimate payoff for building an institutional moat. It's how a company transcends mediocrity and achieves generational success. We now arrive at the fifth and final pillar. This is the ultimate stress test for any investor or leader's commitment to independent thinking. It is the ability to resist the most seductive and dangerous manifestation of the institutional imperative, the New Era delusion. This is the belief, which takes hold during every great speculative bubble, that this time is different. It is the siren song that proclaims the old rules of valuation and business no longer apply, and that a new technology or a new paradigm has changed everything. Resisting this narrative, when it is at its most powerful and universally accepted, is the final exam of financial wisdom. Warren Buffett's career provides a masterclass in acing this test, not once, but repeatedly. Let's travel back to the early 1970s to the Nifty 50 era. This was the original New Era bubble of the post-war period. The institutional imperative of the day decreed that there were about 50 large-cap, blue-chip growth stocks, companies like Xerox, Polaroid, IBM, and Coca-Cola, that were so good, so dominant, that you could buy them at any price and hold them forever. They were one-decision stocks. The decision was just to buy. The valuation was considered irrelevant because their growth was assumed to be perpetual. This was the consensus view on Wall Street. The big banks and mutual funds poured billions into these 50 names, driving their valuations to astronomical levels. It was not uncommon for a Nifty 50 stock to trade at 50, 80, or even 100 times its annual earnings. The narrative was powerful. These companies were building the future, and you had to be on board, no matter the cost. Buffett, of course, refused to play. He looked at the prices and, while he agreed that many of these were wonderful businesses, he could not make the math work. The prices being paid discounted not just a rosy future, but a perfect one. There was no margin of safety. As the Nifty 50 soared in 1971 and 1972, Berkshire Hathaway's stock underperformed significantly. Just as with the dot-com bubble 3 decades later, Buffett looked like a man out of touch. Then came the brutal bear market of 1973-74. The economy soured, and the magic of the Nifty 50 evaporated. These one-decision stocks collapsed. Polaroid fell over 90%. Xerox fell over 70%. Avon fell over 85%. The investors who had bought at the peak, believing the New Era story, were wiped out. It was a bloodbath. And what was Buffett doing? He was buying. The crash had created the single greatest bargain-hunting opportunity of his career up to that point. It was during this period that he made his famous investment in the Washington Post company, buying a huge stake for a price that valued the entire iconic newspaper at a fraction of what it was worth. He was able to do this because he had resisted the New Era narrative at its peak, preserved his capital, and was ready to act when the delusion shattered and fear took its place. He saw the exact same pattern repeat in the late 1990s. The narrative was different. It was about the internet instead of dominant blue chips. But the underlying psychology was identical. Again, the cry was, "This time is different." Again, valuation was dismissed as an outdated concept, and again, Buffett refused to participate, endured the public criticism, and was ultimately vindicated when the bubble burst. This is not just a story about being a contrarian, it's about having an unwavering commitment to a set of timeless principles, an anchor of logic that holds fast when the rest of the world is swept away by a tidal wave of narrative-driven delusion. Why are we so susceptible to these new-era stories? The answer lies in two powerful psychological traps, the narrative fallacy and the overconfidence bias. Together, they create a perfect storm of delusion that fuels every speculative bubble in history. The narrative fallacy, a term coined by scholar and investor Nassim Nicholas Taleb, describes our tendency to create and believe in coherent stories to explain complex random events. Our brains are not built to process raw data. They are built to understand the world through narrative. A good story is simple, memorable, and emotionally compelling. The Internet changes everything is a powerful story. A diversified portfolio of fairly valued cash-generating businesses will likely produce a satisfactory return over the long run is not. During a bubble, the new era story takes on a life of its own. It's repeated by the media, by analysts, by our friends and neighbors. It creates a feedback loop of social proof. The story seems more and more true simply because everyone believes it. We fit all incoming data into the narrative. If a dot-com company with no profits sees its stock price triple, we see it as confirmation of the new era story, rather than as evidence of speculative excess. The narrative becomes our reality, and we are unable to see facts that contradict it. This is amplified by the overconfidence bias, our tendency to overestimate our own knowledge and ability to predict the future. The experts who promote new era narratives, the star analysts, the celebrity CEOs, the tech visionaries, are often genuinely brilliant people. Their past success gives them, and us, an inflated sense of their ability to forecast what's next. They start to believe their own hype. This confidence is contagious. When a charismatic expert confidently proclaims that the old rules no longer apply, we are psychologically primed to believe them. Skepticism feels like pessimism. Caution feels like ignorance. Buffett's ultimate defense against this is his relentless, almost boring focus on timeless fundamentals. He is not immune to a good story, but he has a system that forces him to subordinate narrative to numbers. His investment criteria, a business he can understand, with a durable competitive advantage, run by able and honest managers, available at a sensible price, act as a filter. A new era company might have a great story, but it almost always fails the price test. By demanding a margin of safety, by refusing to pay for a perfect storybook future, he systematically protects himself from the narrative fallacy. He doesn't try to predict whether the story will come true. He simply observes that the price already reflects a better-than-perfect outcome, and on that basis alone he walks away. This is the ultimate expression of intellectual humility in a field dominated by overconfidence. It is the recognition that the future is fundamentally uncertain, and the only protection an investor has is the price they pay today. To protect ourselves from the next great new era delusion, we need our own systematic filter. We need a mental model that acts as a bubble detection kit. We can call it the 4 horsemen of the bubble apocalypse test. If you are considering an investment in a hot, popular sector, and you see all 4 of these warning signs, the model dictates that you are likely in a speculative bubble and should stay away, no matter how powerful the temptation. Horseman number 1. Sky-high valuations based on unconventional metrics. This is the most fundamental sign. Are companies in the sector being valued at levels that are extreme by historical standards? Are traditional metrics like the price-to-earnings ratio being dismissed in favor of new, more forgiving ones, like price-to-sales, price-to-clicks, or even more esoteric concepts? Is the justification for these valuations based on profits that are projected to appear many years in the distant future? If the answer is yes, the first horseman is riding. Horseman number 2. A compelling this time is different narrative. Is there a pervasive, easy-to-understand story that explains why the old rules of finance no longer apply? This story will usually be centered around a revolutionary new technology or a paradigm-shifting business model. The narrative is crucial because it provides the intellectual justification for the sky-high valuations. It's the story that allows people to suspend their disbelief. When you hear the phrase, "This time is different," uttered without irony, the second horseman has arrived. Horseman number 3, mass public participation. Has the investment theme crossed over from the financial world into popular culture? Are you hearing about it from people who have never shown an interest in investing before? Your dentist, your relatives, your Uber driver? Is it the subject of fawning articles in mainstream news magazines and breathless segments on television? When the general public, armed with newly opened brokerage accounts, piles into a sector with dreams of easy riches, this is a classic late-stage sign of a bubble. The third horseman is in the saddle. Horseman number 4, the scornful rejection of skeptics. What happens when someone raises a voice of caution? In a healthy market, skepticism is welcomed as a necessary part of price discovery. In a bubble, skeptics are not just ignored, they are actively mocked and ridiculed. They are dismissed as dinosaurs, as fools who don't get it. There is social and professional pressure to get on board with the new paradigm. If you see critics being shouted down rather than debated, you know that the final horseman, the one that signals the triumph of emotion over reason, is on the move. When all 4 of these horsemen are riding, the apocalypse for that particular asset class is usually not far behind. This test is not a market timing tool. It will not tell you the exact day the bubble will pop, but it serves as a powerful environmental warning system. It is a checklist that forces you to step back from the emotional excitement of the moment and assess the situation with the cold, detached logic of a true independent thinker. It is your final line of defense against the most dangerous story the market ever tells. The path of the 99% during a new era bubble is a tragic 4-act play. Act 1, intrigue. The story begins to take hold. They hear about a new technology or trend and the incredible profits being made by early investors. They are curious, but hesitant. Act 2, capitulation. The trend accelerates. The prices of assets in the sector go parabolic. The stories of overnight millionaires are everywhere. The pain of missing out becomes unbearable. They see their neighbors and friends getting rich, and they can no longer stand on the sidelines. They capitulate. They throw their caution to the wind and pour their savings into the mania, often at or near the absolute peak. They are now true believers in the "this time is different" narrative. Act 3, denial. The bubble pops. The prices start to fall. At first, they are in denial. They tell themselves it's just a healthy correction, a buying opportunity. They might even average down, throwing good money after bad. They cling to the narrative that saved them from their fear of missing out, refusing to believe the story is over. Act 4, despair. The decline continues, relentlessly. The 20% correction becomes a 50% crash, then an 80% wipeout. The denial finally shatters, replaced by panic and despair. They sell everything that's left, desperate to salvage some small fraction of their original capital. They are emotionally and financially broken. They vow never to invest in the stock market again. This is the predictable path for those who have no anchor, no system for resisting the pull of the narrative. They are swept up in the collective euphoria and then crushed by the collective panic. The dot-com crash, the 2008 housing crisis, and countless other speculative manias throughout history are filled with millions of these stories. People who believed the narrative, who ignored the warning signs, and who paid the ultimate price. They were not victims of a rigged game. They were victims of their own predictable and exploitable human psychology. They were victims of the institutional imperative in its most virulent and destructive form. The direct financial connection of this final pillar is the most stark of all. It is the difference between the preservation and compounding of capital and its permanent, catastrophic destruction. Succumbing to a new era delusion doesn't just lead to underperformance. it leads to the kind of losses from which it is almost impossible to recover. Let's look at the simple, brutal mathematics of loss. If you lose 50% of your capital, you need to make a 100% return on what's left just to get back to even. If you lose 90%, as many did in the dot-com crash, you need to make a 900% return to break even. The compounding machine, the engine of all long-term wealth creation, is shattered. This is why Buffett's #1 rule is never lose money, and rule #2 is never forget rule #1. He's not talking about small, temporary dips in the market. He's talking about avoiding the big, permanent losses of capital that come from getting caught on the wrong side of a busted bubble. The financial statements of bubble-era companies tell the story. They often have no profits, negative cash flow, and a balance sheet dependent on a constant infusion of new capital from eager investors. They are story stocks, not businesses. Contrast this with the financial statements of a typical Buffett-style company. A long history of consistent profitability, strong and predictable cash flows, and a fortress-like balance sheet. One is built on narrative. The other is built on economic reality. By avoiding the great bubbles of his time, Buffett has done more than just sidestep losses. He has ensured that his compounding machine never breaks. His capital base is always preserved, always ready for the next great opportunity that inevitably emerges from the wreckage of the last great mania. The greatest financial advantage is not about capturing every last dollar of upside in a bull market. It is about having the discipline to survive the bear markets with your capital and your sanity intact. The new era delusion is the ultimate test because it promises a shortcut to wealth. It promises a new, easy path that bypasses the hard work of analysis and patience. But as Buffett has proven for over half a century, there are no shortcuts. The path to lasting financial freedom is paved with independent thinking, emotional discipline, and an unwavering focus on the timeless principles of business and value. That is the final promise. You have just been given the blueprint to erect a powerful defense against the single most destructive force in business and investing, the institutional imperative. You now understand the psychology of the herd, the cognitive biases that drive smart people to make foolish decisions in groups. You possess the mental models, the independent premise filter, the circle of competence mandate, the fear and greed barometer, the decentralized ownership framework, and the 4 horsemen test, to stand apart from it, to protect your capital and your career from the tides of corporate faddism and market mania. But this defense, this ability to resist groupthink and avoid catastrophic error, is only one half of the equation. Warren Buffett's genius wasn't just in avoiding the mistakes of the crowd, it was in simultaneously building an engine of creation, a system for proactive capital allocation that turned a failing textile mill into the world's greatest compounding machine. Resisting the tide is survival. Building the ark is true financial wisdom. The video that is now on your screen is the next part of that map. It moves beyond the defensive strategy of independent thinking and into the offensive architecture of wealth creation. It explores the other half of the system, the principles of capital allocation, the focus on moats and management, the machinery of compounding. It is the link that connects avoiding foolishness with the active, relentless pursuit of extraordinary opportunity. Many will be content with the knowledge they've gained here, with the powerful shield they can now wield. But for those who are serious about building not just a portfolio but a legacy, the journey must continue. The choice to click is a choice to move from observer to architect. Complete your mental arsenal. Begin the next stage of your ascent.